So hello learners, welcome back again to this class. Today we are looking at the financial management. The topic we are looking at is the financial analysis and forecasting. Financial analysis and forecasting. Under the financial management, this is intermediate level. It is intermediate level of the CPA, that is Certified Public Accountant. Certified Public Accountant. We have done the explanation of this topic, that is the financial analysis and forecasting. We have all the notes from our previous video, or previous class. So today we are going to look at specifically the illustration, and the illustration we are looking at is May 2016. May 2016 question 3A. Question 3A, May 2016, question 3A, that is the specifically question we are going to tackle today. So we read the question. The following data was extracted from the financial statement of the Deribuni Limited for the year ended 31st December 2015. We have the cash and cash equivalent. We have the fixed asset, the sales in bracket credit 2,000 or 200, 2 million. So remember the values are in millions. 2 million, 2 millions. And we have the current net income. We have the current liabilities. And also we have the current ratio. Which is 3:1. We have the note payable to bank 40. We have the debtors collection period, that is 40.55 days. And return on equity is 12%. The return on equity is 12%. So assume 365 days in a year and required account receivable. So the first one requires to table account receivable. So account receivable is debtors. So we need to add the formula. How do we get this account receivable? So generally when they ask for account receivable, you have to know this formula, like how do we get the account collection period? How do we get this account collection period? Because they have already given us. So the formula which will help us to get this account receivable is account receivable collection period, which we said we take by getting 365 times the average data, which is this receivable, we divide by annual credit sales. Now they have given us this, and we have this and we have this. So we have now to get this the account data or account receivable. So if you look at in our illustration, they have given us a data collection period of 40.55 days, which equivalent to 365 times the average data we are looking at. We divide by the annual credit sales, which is 2,000 year. So you can cross multiply so that we remain with this. So if you take 45.55 times 2,000, equivalent to 365 times AB. So this one you can multiply this one, we divide by 365, so that you can be able to get account receivable, which you can have that. So get that one. 40.55 times 2,000, we divide by 365. We are getting at 22. 20. You can put through this small place 0.9, 21.9. That is our account receivable. Then the next question number two, which is Roman 2, guys, is asking for the current ratio. Ratio. How do we get this current ratio? So the more important thing in financial management, is to get the formula That formula will guide you on which variable do I need. So the current ratio will take the current asset, we divide by current liability. We divide by current liability. We divide by the current liability. Let's look at our variable. They have given us the current ratio. We have the current ratio that is 3 to 1. Have the current ratio 3 to 1. So if you have the current ratio, we have this current ratio 3 to 1, 3 to 1, equivalent to CA. Then the question is asking for the current asset. The current asset. We have the current liability. We can get the current liability. So look at our current liability. They have given us the current liability being 211. So we have the current liability being 211. So we can comfortably come now and get our current asset, which our current asset will be, our current asset will be 3 times 221, which will give us how much? To give us how much? 3 times 221 will get 633. That is our current. That is our current. That is our current asset. That is our current asset. That is our current asset. Then the next one is asking for return on total assets. Return on total assets. The next one, which is Roman 3, is asking for return on total assets. Return on total assets. Return on total assets. So how do we get this return on total assets? How do we get this return on total assets? So whenever you hear the term return, think of what? Think of a profit. Whenever you hear the term return, you think of a profit. Think of a profit. So here we will take that is the return on asset. We will take the profit after tax. We divide by total asset. We divide by total asset. We divide by total asset. We have our profit after tax. Yes, they are given as the net income. That net income is the profit after tax, which is 100. We divide by the total asset. The total asset composed of what? When you talk of total asset, we are talking of the fixed asset plus the current asset. We are talking of the fixed asset plus the current asset. Already we have the current asset here. Current asset. So what we are looking at is the fixed asset. We have the fixed asset of 5. So we have the fixed asset 567, and we have the current asset here 633. So we can add the two so that we can get the total assets. So 557 plus 633. We have the 1200. 1200 being our total asset. So let's get the return on total asset. Take 100 divided by answer. Get it. If you multiply by 100, because this one is a return, get 8.33%. 8.33%. That is the return on total asset. That is the return on total asset. That is the return on total asset. The next Roman is there. They are asking for equity. So the next one, they are asking for equity. They are asking for equity. They are asking for equity. So once we say equity, so which formula will help us to get the equity? The first thing is you ask yourself, which formula can help us to get the equity? The formula which can help us to get the equity is the ROE, return on equity. The ROE can help us to get the equity. And we said to get the ROE, you get the profit after tax, you divide by equity. You divide by equity. We divide by equity. Now, do we have the ROE, the return on equity? They have given us the return on equity is 12%. They have given us the return of equity is 12%. And also we have this 100. We divide by equity. We divide by equity. So you can cross multiply and say equity equity will be what? We check that is 100, we divide by 0.12. If you convert this one, you remove that percentage. So how much is our equity? How much is our equity? Will be 100, we divide by 0.12, we get 833. This is our equity. This is our equity, 833. That is our equity. Then the next one is asking for the quick ratio. The next one is asking for quick ratio. Quick ratio. How do we get this quick ratio? So quick ratio, my good student, you take the current asset minus inventory or stock, we divide by the current liability. We have our current asset being 6333 minus, let's look at the inventory. Our current liability, we have that one to 11. Let's find out the inventory. We have the inventory. We have the inventory. We have the inventory or the stock. The stock, we have debt collection period not payable to the bank current liability. Yes, we have there. We have that one. The current stock we have. 222 is our current yes, so we assume that the current asset, which is that's let's find out which we have the current stock, So we have the current stock, we don't have the current stock here. They have not given us the current stock. If they have not given us the current stock, the inventory, we have the fixed assets, they have not separated that one. So if you assume we don't have, then our quick ratio will be the same as the quick cap. So we just divide this one because we don't have this. We don't have that. So you just divide and get that is 633, we divide by 210, 211. We get a 3. That is 3. So it should be 3 to 1, 3 to 1, which is it should be the same with the current ratio because we don't have the inventory. We have not given us the inventory. So that is it, guys. So let's meet on another illustration under the financial analysis and forecasting. Financial analysis and forecasting. Thank you.